Hey, my name's Andrew Dunn. This is the State of the Market Report for December 2022. We're going to dive into Blackstone's $69 billion REIT having withdrawal issues, Jerome Powell giving us an update on his future interest rate hikes, inflation, and the current labor market, and then the U.S. housing recession, and is there going to be a crash occurring, and when will that occur? Blackstone's $69 billion REIT is having withdrawal issues. Why is this occurring? Investor psychology is getting pretty weird out there right now in the current state of the market because these investors are seeing headlines of economic recessions, U.S. housing crisis, people from China are pulling out their money because they're having their own internal country issues. But what do I see as an investor listening to all these different big REIT CEOs? I'm seeing that there's not a real fundamental issue in the commercial real estate market. It's just the way these funds are structured. If I have $10,000 and I invested in Blackstone's $69 billion REIT, I have different positions of liquidity. Blackstone has the right with my $10,000 to take $1,000 to buy this property, $3,000 to buy that property, and then they're waiting for the rest of my money to be deployed. So some of my money is liquid, but other pieces of my money are already committed to properties. Properties are illiquid asset classes, and you can't pull your money out even if you are a Blackstone. So these are the issues that they're trying to limit, is it's just a perception of investor psychology. There's not really a true fundamental issue in this withdrawal crisis. The interest rate godfather, Jerome Powell, who's been controlling all of our lives if you're in the real estate market, came out on November 30th in a New York conference stating his perception of future rate hikes, inflation, and the labor market, and how these different factors are going to influence how he sees the federal funds rate going with the Federal Open Market Committee. He's now showing a tapering process, and he's now seeing inflation has been cracked from its 8-9% highs, now going into 6%. He still sees strong demand in the labor market, showing strong resistance against a recession in regards to the labor market because people are still getting hired, jobs are still being created, they're just being redistributed throughout our economy because unemployment is still remaining strong at 3.7%. So my prediction for future interest rate hikes is a 50 bip increase in December, 2 more 25 basis point increases in Q1 of next year in 2023, and then they're going to stagnate the interest rate hikes and they're going to see how inflation reacts. But his main driver that he honed in on was inflation and his inflation target of 2%. If there is not a downward trend to inflation of 2%, he will continue to raise rates until he hits his target. Is the U.S. in a housing recession? And is it heading for an economic crash? First, you have to look at the facts. During COVID-19, we have pent-up demand with low interest rates and low mortgage rates, giving people more affordability for so much house than ever in U.S. history. Now that the federal government has been raising interest rates and causing mortgage rates to increase, it's driven that affordability down dramatically for average consumers. Before, you had everybody competing for the same type of house. Now there's barely anybody that can afford these houses in today's market with these interest rate payments because they've gone up 50% year over year. Inventory has gone up dramatically in the U.S. housing market. We've seen a strong increase, actually the fastest increase in mortgage rates in U.S. history since we started tracking interest rates, and it's caused an economic stall in regards to buying activity. Also, for sellers, they don't want to throw their houses on the market because of the interest rates they have locked in at sub 4%. If they were to go out and sell their home and capture the equity that they've gained in their homes over the last couple of years, they can't find a comparable product as a replacement for the equity that they have in their home because the payment is so high due to these high mortgage rates. Now, mortgage rates have been drastically increased over the past year, as we've seen and everybody's seen in this market, but you're starting to see them taper down with predictability and stability from the Fed in the previous comment to Jerome Powell. If Jerome Powell provides stability and a predictable increase in rates, the market can adapt to this stability. That's what real estate is. People invest in real estate because it's stable and predictable. High appreciation of 20%, downward depreciation of 5 or 10%, that's not the value of real estate. Real estate has intrinsic value to people with growing population and growing economic demand in its certain markets. If it has this underlying intrinsic value, it's going to be susceptible to various interest rate increases because those are more volatile, causing various pricing pressure on the housing market. Inventory is climbing. People are still actively looking to buy homes. Sellers aren't drastically flooding the market. I just think you're returning to a stabilized market that we haven't been accustomed to over this last bull run cycle that has been occurring between 2012 to 2015, depending on your market. I don't think there's going to be a real estate housing crash. I think there's going to be a correction of 10 to 15%. That's my state of the market update for December of 2022. If you have read some articles that have changed your opinion on the real estate market or just the overall investment markets, please drop them in the comments below. If you want to understand more about commercial real estate and commercial real estate investing, check out these videos here.